Welcome to Q1 Industrial Stats. Don't worry, I'm not about to walk you through a spreadsheet like it's a bedtime story. Availability is up, rates have come down slightly, pricing has adjusted. That's the headline. Except two buildings on the same street are having a completely different outcome right now. One is leasing, one is sitting. So the real question isn't what's the market doing, it's why are some winning and others are not even getting a call. I'm Susan, that commercial realtor. I work with industrial owners and tenants and investors across Burlington and the GTA. Built for business, backed by data, negotiating with bite. If you're evaluating industrial space right now, this isn't about the stats. It's about how to use these stats before the market uses them on you. Is the market lying to you? You'll hear things like rents have softened, there's more available space, there's more choice. And all of these are technically true. Availability has moved up again this quarter, not dramatically, not into fire sale territory, but enough to shift conversations. This is no longer the landlord-controlled market we saw just 2 years ago. This is a negotiation market. The part most people are missing is not all industrial space is competing with each other anymore. Functional space, it's still moving. Power-ready buildings are still in demand. Well-located product along the QEW 403 corridors, they still get attention. There's even new construction delivering right now, and it's already partially leased. That tells you everything. The rest, that's where the softening lives. So what does this look like in real life? If you're an owner, you're not competing against the market. You're competing against newer product, better layouts, buildings with power already in place. And right now, tenants have just enough choice to compare properly. That's new. If you're a tenant, yes, you have more leverage than you did just 2 years ago. Rents have come off slightly from their peak, and landlords are more open to incentives and structure. Not desperate, just realistic, which is exactly where good deals get done. If you're an investor, sale pricing has adjusted. Cap rates have held relatively steady. Lease rates softened slightly and values have followed. That gap between what sellers want and where deals are actually closing, that's where opportunity lives, if you're paying attention. So what's the notable shift? Well, what's changed are expectations, not demand, not fundamentals. Availability creeping up created space to negotiate. Slight rate adjustments reset conversations. Buyers and tenants stopped chasing and started evaluating. Owners are adjusting, tenants are pushing, landlords are negotiating in ways they haven't had to in years. And the deals getting done? They're not always the obvious ones, they're the well-structured ones. If you're looking at industrial real estate in Burlington or the GTA, you need to stop asking where the rates are going and start asking, where do I sit in this market and where is my leverage? Because right now, those answers determine whether you're negotiating or reacting. Follow along if you want to understand how these shifts impact your next move before the market explains it to you the expensive way. And if you want to know the Q1 stats for office, check in next week. I'm Susan, that commercial realtor, built for business, backed by data, negotiating with bite. Now that you know, what are you going to do about it?